Morning, everyone. Thank you so much for joining us today. And wherever you are, I hope you've got a nice sunny day like we do here in Portland. Sort of rare for this time of the year, but hey, I'll take advantage of it. So today's title is Rollover Roundup, Managing Life Changes with Your Retirement Account. And we're going to be talking all things self-directed, I guess. And first thing I want to say is when we're creating these accounts, it's not an all or nothing situation. I mean, you've got the ability to move as much money as you want to move into one of these investment vehicles. And if we're looking at a 401k plan situation where we're creating a solo 401k, let's say for you, we're probably going to want to, as long as we're talking about traditional money, not Roth money, we're going to want to move all of it into that plan and do what we're going to do. If we're talking to IRAs, we're probably just going to want to move the funds you want to use in a self-directed capacity into the new account, because we are probably more concerned in that situation of protecting funds. And what I mean by that is that if you've got a Wall Street retirement account, you can obviously make a poor investment decision, but you're not really going to be in a situation where you can commit a prohibited transaction. And in the truly self-directed world that we're talking about today, you have the power of the pen. You've got the ability to create a problem for yourself if you choose to, or you don't pay attention. So the problem with a prohibited transaction with a self-directed IRA, or any IRA account for that matter, is that all funds in the account are treated as distributed as of the first day in which the indiscretion occurs. A 401k plan is totally different in that only the funds involved with the indiscretion are treated as distributed with that indiscretion. Why is the difference? I don't know. Some senator had a 401k plan. He can't try to rationalize this stuff. But anyway, the reality is when you engage us to put one of these accounts together, we're going to create an account that literally allows you to make any investment the law allows. And that menu you'll hear more about in a few minutes is very, very broad. Once again, my name's David Moore. My brother and I, Tom, opened Equity Advantage to handle 1031 exchanges, 1031exchange.com in 1991. IRA Advantage was a result of our 1031 clients coming to us wanting to use their money, their qualified money, IRA 401k funds for more real estate projects, whether it was making loans, buying notes, buying real estate. That was our primary intent, was to accommodate their needs. And shortly after we put the business together, we had a recession, and we ended up doing a whole bunch of other things with these accounts that we really had not initially intended to be involved with. An example would be a rollover business startup, which literally creates an investment company, or not investment company, creates a new business owned by your retirement account that you're going to work for. So that was something we did a lot of. We bailed out properties during that time. Somebody would talk to us and say, look, I've got this property. And in some cases, honestly, even the bank was going away. So we were in a situation where the IRA 401k plan was sort of a life preserver to keep people's assets intact. And what I mean with that comment is that if you look at let's say you own a personal piece of property and it's got a lien on it and you're behind, and now the bank's calling the loan, or worse yet, the bank's going away. That loan's going to go away. The property's going to go away. Well, if you look straight up and think, okay, could I take my IRA 401k to pay off that property? The answer is no, you can't. That's a prohibited transaction because there's a benefit to a disqualified party. Does that mean that that's not possible to do? And the answer is, it is possible to make that thing happen. It's just going to complicate investments a little bit, but it will save the asset. And the way we would do that is we'd create a new limited liability company. You personally would be contributing that property into that limited liability company. Simultaneously, the retirement account's making an investment in the limited liability company. The limited liability company now has the property and has the cash to pay the property off. So that's just a very quick example of what is possible. And I'll just caution you, when we're talking about things in this space, if we look at 1031 is over 100 years old at this point. IRA's 401k plans came to be in the mid-70s, all right? 1031, there's a fair amount of case law out there, but when we start looking at IRA's 401k plans, self-directed accounts, making off Wall Street investments, there's not a lot of case law out there on this stuff. And I sort of feel as though a lot of the CE in this space is provided by Wall Street firms. So when you start talking to your financial people or your tax people about doing these things, I think a lot of times their reaction, well, you can't do that. And that's really, this is not new, okay? Self-directed accounts are not new. To be able to go buy real estate with an IRA or 401k plan, that's been possible since the advent of these accounts, period. So nothing we're talking about today is new. It's always been possible. It's just a very well-kept secret. So we're going to talk about rolling things into these. A rollover period is your opportunity to make things happen. You change jobs, you hit 59 and a half, previous employer plans, or you hit that age, you've got the ability to take your money and do what you want with it. As long as you're moving from retirement account to retirement account, you're not going to have any tax consequence. I'm also going to stress, we are not taking money out of your retirement account to do these things. If we're talking about IRAs, we're simply moving from one trust company that won't allow you to do what you want to one that does. We're talking about a 401k plan. We're just really looking at, well, I better start off saying, quite often, I've found that administrators or trustees of plans don't even fully understand what their own plan documents allow people to buy. And I'll give you a couple stories later. But if we look at a 401k plan, typically we're just looking at, okay, take a look at the plan. Does the plan allow that person's chosen investment? If it doesn't allow it, can it be amended to allow it? If it can't be amended to allow it, you're going to replace it. So, that's really what we're doing. IRAs, we're moving, we can move IRAs from any IRA can be self-directed. If we're talking about moving IRA money into a 401k plan, we've got restrictions on Roth funds and a beneficiary IRA, one that's been inherited. We can't move those two things into a 401k plan. A 401k plan can contain traditional, pre-tax money, and it can contain Roth funds, but we cannot migrate Roth IRA funds into a 401k plan, nor can we take an inherited IRA, a beneficiary IRA, and roll those into 401k plans. Either one of those can be self-directed, though, with respect to a self-directed IRA. So we're going to have a little fun. We got an hour to get through this stuff. I'm going to do my best to stay on track. I trimmed a couple slides. I have a tendency to speak quickly, and I always have sort of a feeling I'm going to be, I'm optimistic in my ability to get through more than I have the actual time to do. But we're going to get through it. If you've got questions on this stuff, we're not going to address these questions during the class, but you can also reach out to C-Moore, C-M-O-O-R-E, at IRAadvantage.net, C-Moore at IRAadvantage.net, and she can get the slide deck will be available afterwards. The presentation will also be on YouTube. And I would say if you're a real estate broker in the state of Oregon, you're looking for CE, this class does qualify for 1 hour. So you can also reach out to CC at cmore at 1031exchange.com or cmore at IRAadvantage.net to get your CE for this class, if you're so inclined. So away we go. Okay, I cut out on you guys for some reason. At what point? Okay. So what I was saying is, I apologize, for some reason the audio cut out for me, but now you get me again. So what I was going to say is, if you're working with tax money and you've got real estate investments and you're looking at sheltering that money via 1031, we can accommodate you through 1031exchange.com. If you've got qualified money, you're looking to buy things Wall Street doesn't sell, we're going to help you out with IRA Advantage. Regardless of where we are with this stuff, we provide the investment vehicles. We do not sell investments, nor do we provide investment advice. So we're going to want you to work with your tax people as you normally would. We're going to want you to work with your financial advisors as you normally would. And I would say if we're looking at 1031 space, you're always looking at a situation where the exchange itself has an opportunity cost. You've got a finite period of time to find what you want and to actually close on it. And so the first thing you want to do anytime you're contemplating sale is understand what the tax liability is going to be, and then start thinking, okay, what am I going to do with this money? But whether you're working with the 1031 stuff or the IRA stuff, we do not sell investments. We do not provide investment advice. We provide the investment vehicle. And we can actually blur the lines between the two. We can actually combine 1031 money and qualified money into a common investment. And that's one of those things that we will talk about in a little while. It's got to be done correctly, and you have to be, it's got to be set up correctly from day one and really handled well. So anytime we're looking at these transactions, there are critical issues that need to be addressed sooner rather than later. You need to plan ahead and plan it and follow that plan and don't leave it to the last second. So only dumb questions when you don't ask. It's your money. Do what you want with it. Now, there's a lot of talk right now because our politicians, for some reason, have a better ROI on their Wall Street investments than we do, right? So there's a lot of talk on what's allowed and what's not allowed. I'm not Martha Stewart's biggest fan, but I got to tell you, she's not the biggest problem in insider trading. Okay, they just made an example of her, which I think is very unfortunate. They need to go after the real villains in that space, and I think we've got lots of examples of people that somehow are making miraculous trades just before things are coming to light in our political world. So typically, if you look at Wall Street, it's not legal for you to take advantage of insider trading. All right. But if you are a mortgage broker and you would like to, and I just had this conversation with a mortgage broker yesterday, and he's a real estate broker, mortgage broker, and he wants to take his money and make loans. Well, you can do that. Why not take advantage of your knowledge? I would say that you're in a situation where you're reducing risk and you should be increasing your ROI. And in the self-directed world, you can take advantage of your gray matter and really work to make things happen. So in that situation, he's actually currently got a SEP IRA. And we're going to be shifting from that SEP IRA into a solo 401k plan, which we'll talk about both those in a little while. And then that plan will be the lender for these loans that he's going to be making, or that 401k plan can be the owner of the notes, or that 401k plan can actually go out and buy real estate. And he is going to be the trustee of that plan. So he's literally going to have a new 401k plan. That plan's going to have a bank account in the plan's name and EIN, and he as trustee of the plan is literally able to make an investment by writing a check. And that note is going to be between the borrower and his 401k plan. If you wanted the additional protection of a limited liability company, it's easy to just stick the LLC between the plan and any investment. We have to use that structure for checkbook IRA. So in the IRA world, we're always going to be creating that LLC. But in the 401k world, it's sort of up to you whether you want the addition of that limited liability company, which, for nominal cost, you've got that. And it just adds a layer of separation between, whatever the investment is and the plan itself. But, it's your money. Why not do what you want with it? And like I said, in Wall Street, you can't take advantage of specific knowledge on a given investment that's insider trading. But in the self-directed world, if you've got specific knowledge, you want to reduce the risk, increase your ROI, why not do that? A self-directed account, that's not a legally defined term. It's a term that describes an account that allows you to go out and buy what you want to buy. And as I said, it's not a new thing. But if we're looking at, back to my comment a couple minutes ago, if we're looking at a IRA, we're just moving money. We're not pulling anything out of the account. We're just going to roll funds from a trust company. It won't allow you to do what you want to do to one that does. If we're talking about IRAs, I'm going to encourage you to keep your Wall Street investments with your Wall Street advisors and only move the money you want to use in the self-directed world into that new account. Because if you did commit a prohibited transaction, that transaction, prohibited transaction, will not encumber the Wall Street investments in a different account. If we move everything into the checkbook IRA and you open a trading account, that's the easiest way to sort of move funds back and forth. And it's common for people to want to do that, because if you buy that investment property and now it's cash flowing, as the cash flow builds up the balance in your checking account for the IRA LLC, now you're saying, gee, this money's sitting here, the bank's not paying me anything, I want to shove it back in Wall Street. The easiest way to do that is to open a trading account in the LLC's name and EIN. But the problem with doing that is now an asset of that account. And if you blow up something on the other transactions, and we'll talk about prohibited transactions in a while, but if you did that, it would uncover the Wall Street investments. Where on the other hand, if you've got that total segregation, you've got your Wall Street accounts with your financial advisor in a different account, you've got the self-directed stuff in that separate retirement account, now that indiscretion is only going to impact that account. The 401k plans, as I said a few minutes ago, we don't have to treat the same way. So I'm going to say if it's all pre-tax money, traditional IRA funds or 401k funds, let's move it all into the 401k plan, and then you can go open a trading account with your financial advisor for the Wall Street stuff, and then you've got that plan to go out and do the other stuff directly or via a limited liability company. But once again, none of this is new. It's always been possible. It's just a very well-kept secret. And once again, we're not pulling money out. We're just rolling funds from one type of account into another. And depending on what it is, who you are, what your job status is, what your age is, that's going to sort of drive us in a given direction. So that's why you're here today. Change of career. All right, we hear people talk about that, and so in times, recessionary times, we've got lots of people changing jobs. You know, COVID, we had a lot of people changing jobs. So when we look at funding these accounts, you have the ability to take money out of a 401k plan when you hit 59 and a half. If it's a current employer plan, you've got that ability at 59 and a half to take funds and roll into something else. Now, if you're under 59 and a half and it's a current employer plan, you're stuck. All right. I have had people, so the last recession, I had people literally quit their jobs, get access to money. I've had business owners that want to self-direct into different investments, step away from their firms for a period of time. I had a client this is probably, I don't know, probably 15 years ago or more now, where a client engaged us to do a self-directed account for him. He had left his job, and that gave him access. He was under 59 and a half. He left his job, which gave him access to the previous employer 401k plan funds. We're going to move those funds in the new self-directed IRA, checkbook IRA for him. Well, he went out and got a new job before that whole process was completed. And unfortunately, the new job had the same parent company as the old job. Therefore, the plans were the same. And so we didn't have the ability to get that money out. So if you're looking to do this and you're in between jobs, make sure you understand what you're doing. If you're going to take a new job, make sure that you're clear to get that money out of that previous employer 401k plan. Don't get ahead of your skis and have a problem there. So plan. Take your time. Don't force things, and really plan it out, and ask the questions so that we're able to get where you need to go. I guess one of the other comments I would have is sometimes we'll get started on this process, and somebody will, maybe the stock market, day to day, I haven't looked at where we are today, but it's been sort of ups and downs the last couple of weeks. And you might have a situation where you've got some losses in the Wall Street accounts. You say, well, gee, I've engaged you to put this account together, but now I've got losses. I don't want to realize those losses. And I said, well, you got the losses, whether you realize them or not, they're there. So the question is, are you better off moving these funds now and taking advantage of self-directed investments you want to do, or are you better off leaving the money in the things that gave you the loss? And that's a conversation for you and your financial advisors to have, but something to think about. The other thing I see happen is once in a while, we'll put these accounts together and then they just sit there. All right. So we do all the work to put an account together. It's funded. Everything's sitting there. And I talked to somebody 6 months or a year later. I said, well, how's it going? Well, I haven't done anything. And they started asking, well, why not? Well, it's easy to get upset with your financial advisor if something doesn't work out. But when it's self-directed, it's on your shoulders. So you got to understand that, anytime you're making an investment, there's no guarantees there. But when you're looking at the Wall Street stuff, your financial advisor's working with you on it. When you're back in the self-directed world, it all falls on your shoulders. You got to be prepared to, take advantage of those opportunities, and also understand that they don't always work out. So it is something that these are not right for everybody. They are right for the people that are sophisticated enough and careful enough to keep things going in the right direction. And every time you make an investment with one of these things, I want you to sort of ask yourself two questions. What am I buying? Is it something that qualifies? And who am I transacting between or for the benefit of? Any transaction between or for the benefit of a disqualified party constitutes a prohibited transaction. But these rollovers with career changes, that's what gives people opportunities. We do a lot of rollover business startups when we have career changes for people, and people have a dream of having this business or that, and getting access to their previous employer 401k funds, funding the new business venture with those funds. And once again, we're not pulling money out of any retirement account. The retirement account's literally an owner of the business. This is that olive branch to the future for people, and it's really fun to see people take advantage of those situations. What investment vehicle do I need? Now, I've mentioned a few different things so far. I didn't mention a basic self-directed IRA. I've talked about checkbook IRA, IRA LLC a little bit, and solo 401k, and the ROBS, the rollover business startup. So if we look at this is sort of our menu of things that we're going to be able to put together for you. A basic self-directed IRA just means we're going to move funds from the custodian or trust company that won't allow you to do what you want to the one that does. That account is going to be appropriate for people that are making very infrequent, non-time sensitive, non-management required investments. So if you're going to go and put your money into a project someplace, a couple of years ago we had a company that was buying up a bunch of industrial land that was going to be rezoned for residential, and the qualified money was going to own that property during that conversion period, and then ultimately it was going to be sold to a national developer. So, that qualified money is ideal for that, because if you're using money out of your pocket, you're probably concerned about an ROI sooner rather than later. You may be, if you've got income properties, you want to live off that stuff, where the retirement account, you're not going to touch that money short of a distribution. And if you take a distribution under 59.5, you're going to pay, normal income tax plus a penalty. If you're 59.5 or older, you're going to pay normal income tax on it. But typically people are going to leave stuff in there until maybe they've got required minimum distributions, RMDs, at maybe 73. And for future context, we're talking February of 2026. So those numbers can change over the years. I just need to make sure everyone's on the same page watching this, that we're looking at 2026 today. So a basic account is good for passive investments. So to make that investment in the land hold, that conversion, that's going to be fine, because you're not doing any work that's involved with that thing. You're not trying to manage a property, screen tenants, anything like that. The project's been put together. You don't have an urgency of an investment, and it's going to be totally passive for you. So that is a perfect situation for a basic self-directed IRA. A checkbook IRA is for somebody that wants immediacy of investment, and or they're going to be, let's say they want to go out and buy and manage a property. So when we're looking at an IRA-owned asset, you can manage, you can do the administrative functions of management. You cannot go out and get dirty on it. You can't work on the property in any way, but you can manage that thing. So, keep that in mind, that checkbook IRA is the tool you're going to want to use out, because imagine you try to use a basic self-directed IRA to go buy a piece of property. Well, who do you write the deal between? Because if you look at a deed for a basic self-directed IRA-owned asset, the deed is going to state that it's the title, it's going to read ABC Title Company, CFBO, custodian for benefit of John Smith, IRA number, whatever it might be, 1321 or whatever that thing is, right? So how you write the offer in that same manner, and then who's got the power of the pen for the trust company? Because you're not the owner, you don't have the power of the pen for the trust company. So how do you even get that done? What do you do about earnest money? So those basic accounts are great for, like I said, infrequent, non-time sensitive, passive investments. The checkbook IRA, what we're doing is we're creating the same custodial account as in the basic situation, but we're creating an IRA-specific limited liability company that the trust company makes an investment into. That LLC, you are the manager of it. It's a manager-managed LLC. The member is a trust company, CFBO, your account. You are the manager. You're going to have a bank account in the limited liability company's name and EIN. and that's a bank account's going to have all the funds for investment. And to go buy that piece of property, you're just going to write an offer between the seller and that limited liability company. Any expense is paid out of that account. Any income or benefit of the investment, or when it goes full cycle, the proceeds from the sale are all going to go back into that account. So that is what we typically do for people with IRAs where they want true flexibility. If they want to have, let's say, physical custody of precious metals, that's also the structure we're going to use if we're in a IRA investment vehicle. For people self-employed without employees, we're going to use a solo 401k plan for a variety of reasons, which we'll talk about later. That in that context, as I said earlier, you're going to have a bank account in the plan's name and EIN. You as trustee are able to make investments just as you do with the checkbook IRA. Now, I guess one other comment I would make with respect to the IRA accounts, you've got to understand that, and 401k plans, if you're going to go out and buy something and get a leveraged investment, you want to get a loan to make the investment. Those loans have to be non-recourse IRA or 401k compliant loans. You cannot be a guarantor of those things. The other thing I'll say about checkbook IRAs, do not go out and think you're going to put an LLC together. I don't care how many limited liability companies you've put together for your real estate investments. If you come to us and you've put your own LLC together, you probably are coming to us because the trust company's told you no. They're not going to take your operating agreement, and they're not going to. When we're looking at checkbook IRA or IRA LLC, it is a completely different animal. And you cannot be in control of things. The operating agreement is IRA specific, and the trust companies are not going to take an off-the-shelf LLC operating agreement. If your lawyers are not familiar with this stuff and they start burning through time trying to create it, you're going to spend a lot of time and money with them learning about what the trust company is wanting to see. So my advice is don't try to do it yourself. No, it's up. I was just told my mic might have gone off again, but I see it. It looks like it's working. So anyway, back to my comment. We can't, if you put the entity together and it's done correctly, we're not even going to be able to use the entity on the state level. So when you go out and register the entity with the state, just if you want us, you're working with us, let us do it all. It's just going to be a lot easier, and it's ultimately going to save you a lot of money. So just word for the wise there. Finally, you've got rollover business startups, which is a combination of a C Corp and the 401k plan. So with a rollover business startup, we're literally able to use your retirement account to make an acquisition of a business that you are going to be employed by. And that's a combination. So checkbook IRA is a combination of a IRA and a limited liability company. A rollover business startup is a combination of a 401k plan and a C corporation, and it has to be that combination. We can't use S corps, we cannot use LLCs. Now, a number of years ago, I had a auto dealer that he'd always been the sales manager for car dealerships. He had finally gotten to a point, had enough funds together where he said, look, I've always dreamed of owning my own dealerships. I want to do it. So what we did in his situation is we created a auto dealer management company, because he wanted to own the dealerships as limited liability company. So we couldn't have the rollover business startup own those things directly via the C Corp, or via an LLC using those funds. So we had to use the C Corp. The Robs was the actual management entity that owned the other dealerships that were in the limited liability company structure. So we can do a variety of things. It's just a question of planning it out, taking the time to understand, having the conversations. We're going to talk with you and your tax and legal people and make sure everybody's going and getting what they ultimately want to have to get them where they want to go. Can my retirement account be self-directed? Any IRA can be self-directed. So any IRA can be self-directed. I don't care if it's SEP, simple, beneficiary, Roth, traditional, all those things we can self-direct into self-directed IRAs. If we're talking about moving those IRAs into 401k plans, we have restrictions, as I stated earlier, on Roth funds and beneficiary IRAs. We cannot migrate either one of those into a 401k plan. If we're talking about funding these retirement accounts with 401k plans, we have to look at the investor's age And if they're under 59.5, it's a current employer plan, we don't have access to that money. They're going to have to step away from the company. If they're 59.5, they have the ability at that point to take those funds and roll into their own retirement accounts. And previous employer plans, we can always work with those. So that's sort of in a nutshell, pretty much everything we can work with. It's just going to be, we might have some restriction on which direction you're going with these things. Is it difficult to create these? Now, I already talked about this a little bit. No, it's not. I mean, if we're looking at a IRA, we're just moving from that trust company that won't allow you to do what you want to one that does. We're talking about 401k plans. We're looking at, does the plan allow it? If it doesn't allow it, can we amend it? If we can't amend it, we'll replace it. But if we're looking at, and I'll just say that even though I sell retirement accounts for a living, my company's 401k plan is a Wall Street 401k plan, and it's that because most administrators, trustees, business owners, the feeling is that when we're looking at taking and allowing all our employees to go make any investment the law allows, that those investments may open up more liability for the business owner and everyone else. And a lot of the administrators, trustees don't want to work with those things. So even though I put these together for a living, and my own company is actually got a Wall Street oriented 401k plan, and it's because of the liability issues that are there and just the administration difference in administering accounts that are allowing you to go do things. So typically when we're talking a 401k plan, it's a single participant plan. You could have your spouse involved as well, and a lot of times, if, for example, you're a real estate broker, I just love the solo 401k, and most people that are married in that space and their spouse works at some extent with them, and as long as they're putting in let's say they're making $5,000-$10,000 a year in compensation, maybe as a bookkeeper, they're entitled to participate in the plan too. And you'd have a single plan. You could have a single plan that one bank account in the plan's name and EIN that has both you and your spouse's funds in it. You better be very diligent with the QuickBooks, keeping track of each of your respective funds in those accounts, or you can have a bank account in the plan's name and EIN for each one of you for benefit of each of you separately. Now, we typically do the one because people are typically commingling both accounts into common investments. They want to use all the money to go buy that real estate project, or all the money to make those note investments or precious metals or whatever they might be doing. But these are all conversations we're going to have with you when you're engaging us to talk about the path forward and what investment vehicle is going to work best for you. Common objections. This drives me crazy. All right. And I've got a good friend that we talked to a few months ago. We're going to do a solo 401k plan, a real estate, broker and spouse. And I need to find out what happened. A good friend, because we haven't put it together yet. But I have a good feeling that what happened is he talked to the financial advisor, talked to the tax people, and they said, "Well, whoa, wait, don't do that." And I'm really, sort of always curious why. But these are 4 objections that come up all the time with people when they start engaging their existing professionals if they're not familiar with self-directed accounts. So one, if somebody, talks to their Wall Street advisor and say, "Hey, I want to take some money and go out and buy real estate with that money," they're going to say, "Well, gee, go buy a REIT." Well, REIT is a stock. A REIT, you do not have the benefits and burdens of owning real estate, period. So the first bullet up here, loss of long-term capital gains tax rates. Yeah, why would you take your money and go buy something that you end up having to pay normal income tax? And what I mean by that is, if you take money out of your pocket, you go out and buy a piece of real estate as an investment property, for example, you own it a couple of years and it's been held for investment. When you sell it, you're looking at long-term capital gains tax rates, which federally the top level is, let's say, at 20% on appreciation, 25% on depreciation recapture. If it's something that's held for under a year or held for resale, you might be up to 37%, and then state taxes on top, and then potentially the Housing Assistance Tax Act, the Obamacare healthcare tax at another 3.8 on top of that. So if it's normal income tax, you could be paying in excess of half of what you made in tax. If it's long-term, maybe you're at, knocking at 40%. But If you're looking at a IRA or 401k owned asset, everything that's in that account has to come out at some point. And when it comes out, any distribution is taxed at normal income tax rates. So this top statement, well, why would you do that when you're going to lose long-term capital gains tax rates if you use your retirement account to make that investment? Well, that's true, but there's not an investment you make with your IRA or 401k that's going to give you long-term capital gains tax rates. So that's totally a pointless statement to make. And if you're stating you're better off to take money out of your pocket, go make the investment, because on top of those rates that we just discussed, you have the ability to do an exchange, which would defer all that gain. So, one, if you could only use money out of your pocket or the qualified money to make a given investment, I'm going to say, hey, use the money out of your pocket. But that's rarely the case. What we're talking about is a situation where you're saying, hey, I've got X dollars in a retirement account. What's the highest, best use for that money? And no matter what you buy with that money, you're going to have the same tax consequence at the end of the day. Now, there are situations where in a Wall Street world, you're never going to be subject to, or at least I've never seen a situation where in the Wall Street world, you're going to be subject to unrelated business taxable income, UBTI. That is something that you potentially could face with a self-directed account. And you're saying, well, David, what do you mean by that? We're talking about making investments. Investments, you're going to be totally tax deferred. But if you let's say, create a business transaction with your retirement account, so flipping a property, for example, if you flip properties with money out of your pocket, you're a dealer. Doesn't matter how long it took you to fix a property, you're not going to qualify for 1031, and you're paying normal income tax at the end of the day. You're never going to be entitled to long-term capital gains tax. Now, you could, everybody in that world wants, buy, rehab, refi, and repeat. Okay, well, in that situation, seasoning, maybe if you hold it long enough, then you're going to be looking at long-term capital gains. That's a new concept pretty much. I mean, I think all that craziness probably started, after the last recession. I was taught to buy properties, fix them up, refi them, hold them, stabilize them, maximize the value of it, and then exchange out of that thing. And so we were never looking at a dealer status situation. We were always looking at investments that we were deferring gains on via 1031 at the end of the day. If you're conducting business with a retirement account, even with a Roth IRA, so if you, for some reason, you bought a property, and even if you had other people fixing the thing up the whole time, and you went full cycle on it, went to sell it, and you do that a couple of times, you're a dealer. I mean, you're not a dealer. The retirement account's a dealer, and that retirement account it's conducting business, and it's going to be subject to unrelated business taxable income. Another situation where you're going to be subject to tax, even with a Roth IRA, is on a leveraged investment. So when you look at the income or the return on investment on an unencumbered property, all of that money should be able to grow tax deferred with the IRA 401k. But if you're looking at a leveraged investment, if you buy something and it's 50% loan to value, and once again, it's got to be non-recourse debt, any income or gain attributable to other people's money, that leverage, that debt, is going to trigger tax exposure for an IRA. I don't care if it's Roth IRA, traditional IRA. You're going to have tax exposure on the income or gain attributable to other people's money. For a 401k plan, you don't have that. Don't ask me why. Some senator had the 401k plan. All right. So just be aware there are differences there, but you got to look at whether it's an investment or you're conducting business. 2, cannot be leveraged. This is common. Well, gee, why would you use your IRA 401k funds when you can't go out and get a loan for it? Totally untrue. It's just got to be non-recourse debt. Take a look at myiralender.com or iralending.com. North American Savings Bank is a bank that's been doing this a long time, and you can talk to them. The loans are going to be a little bit more money. They're going to be lower loan to value. They're going to want people with real estate background, and they're going to want to see probably at least 15% reserves. You don't want to spend all the money to buy this thing and have a problem going forward. So just be aware of that. Number 3, what about RMDs? Now, that 15% reserve comment I just made. All right, so understand that a lot of people say, well, gee, why would you buy real estate with this thing? Now you're knocking on the door at 73 years old, let's say, and you're in a situation you got to take an RMD, required minimum distribution. Well, what happens if you spend all the money and you don't have any cash to take that RMD? Well, it's not a problem. You just take an in-kind distribution. Now, that's something Wall Street does not contemplate. We have lots of people that buy properties with their retirement accounts that ultimately they'd like to own. Well, you can't buy it from the retirement account. That's a prohibited transaction. So what we do is slowly transfer the asset to you, or you can take the whole thing out as a single distribution. Don't do it under 59.5 because you're going to have normal income tax plus a penalty. After 59.5, you're looking at normal income tax. So the great thing about an in-kind distribution, you have two situations. Not only is it not a problem about that RMD, but it provides an opportunity. And the reason I say it provides an opportunity is, what is a piece of property worth? When we're looking at Wall Street, at any given second, you've got a stated quoted price. If we're talking about real estate, what is a piece of property worth? It's going to be the highest subject to highest best use. What it's worth to you is going to be different than what it's worth to me. But you've got a valuation there that needs to be made. And it's got to be a professional opinion of value. And you're going to talk about that with your tax people. And then the second piece of it is, if you take the whole thing out, okay, so the upside is you can take the distribution in kind. The downside is you're taking a distribution which triggers tax, which you don't have the funds, you haven't received the funds to pay the tax obligation. If you took 10,000 out of Wall Street, maybe you're going to give up 3 or 4 in tax, right? And you've got 3 or 4 of that money just write a check with. In the in-kind distribution world, you've taken the distribution without receiving cash to pay the tax obligation. So a place that people get that money to pay the tax obligation is to do a cash out refinance of the property after it's been taken by you as a distribution. So that only works if you've taken the entire property out. Now, the other situation which provides a real opportunity is to take in-kind distributions of minority interest. So let's say the property is owned by a limited liability company that has your retirement account as its member. If you take a minority interest distribution, it is possible that you could discount that distribution by up to 40%. So not only is the fact that you took this in kind, that you've got this property tied up, or you've got the property owned by the retirement account and you're looking at RMDs, not only is it's not a problem, but it provides the opportunity valuation wise and also via discounting. So it provides a real tax opportunity. It's not a problem, but you have to understand and be working with people that understand this and are able to give you the guidance and help you get where you want to go. So once again, take advantage of professionals in your life. Ask the question sooner rather than later. Okay. Finally, you lose interest deductions, depreciation if you take your IRA 401k and go buy that piece of property. And that's true. But once again, what is going to give you that benefit in the qualified money world? And the answer is literally nothing. So anyway, those are 4 of the comments that typically come back, and for people when they've engaged their tax or legal or financial people on this topic, and they're talking to people that are unfamiliar with truly self-directed retirement accounts. Is this complicated? No, very simple. 2 things to consider. Okay, if I was looking at 1031, I look at 4. 1, it's got to be an exchange. 2, what's going to receive your like kind. 3, you got to go across or up in value and equity. And finally, we've got to have continuity vesting. That's 1031 speak. In the qualified money world, we're looking at 2 issues. What do you want to invest in, and who you're transacting between or for the benefit of? Okay, and really, as far as investments are concerned, you can buy. Well, I should start off saying, unless it's specifically prohibited, it is allowed. So that's how broad it is. If we were to sit here and talk about things you can buy, we'd be talking all day long. So we're going to talk about what you can't buy. The only thing specifically prohibited from investment with an IRA are collectibles, life insurance contracts, or stock in a sub-S corporation. 401k plan, sole restriction. One restriction for a 401k plan is collectibles, period. Anything else can be invested in with your retirement account. So rarely, if ever, is the retirement account's investment the problem. What causes problems is transactions between or for the benefit of a disqualified party. This page just talks about what I just stated with respect to IRAs, 401k plans. This next page talks about disqualified parties. So who's a disqualified party to your plan or your retirement account? Well, you are, your spouse is, parents, grandparents, kids, grandkids, their spouses, or any legal entity owned in a controlling interest by one of those. So we can transact along with a disqualified party. We just can't transact between or for the benefit of it. So back to my comment on the loans a couple pages ago, you cannot be a guarantor to the loan. You cannot buy a property from yourself. You cannot sell a property to you from that retirement account. So any transaction between your retirement account and a disqualified party constitutes a prohibited transaction. You can manage the assets, but you cannot go out and work on those things. All right. So this page talks about who the disqualified parties are. And, it's really, you just got to think every time, if you got a checkbook IRA, that solo 401k, every time you pull out a check or do a transaction, who am I transacting between and what am I investing in or what am I paying for? These are common examples of prohibited transactions. Assignment of purchase sale agreement from taxpayer to the IRLC. So what'll happen a lot of times is people will go out and find a property. They've heard they can buy the property with the retirement account. So they go out and tie up the property personally. Then they want to sign it over to the retirement account. Most purchase sale agreements are assignable unless somewhere in them they specifically prohibit assignment. So the assignment is not the issue, but the assignment is the issue in that you cannot have the assignment from a disqualified party to a disqualified party. So for you to personally take a property off the market, transfer that PSA over to your retirement account, that constitutes a prohibited transaction. Do not do that. So if you're wanting to do this, you find the property before you're ready. Now, if we go back that last page, I didn't say anything about siblings, did I? Nor did I say anything about aunts and uncles. So if you've got that property you have to buy and you haven't established the account yet, you're not ready to make the offer with the retirement account, have your brother or sister make the offer. Have them tie it up. They can assign it over to you. Have your aunt and uncle can do it, or a good friend, somebody else. But you cannot have a disqualified party do that thing. Recourse, that's another one of those issues that comes up. Okay, you cannot be a guarantor on the loan. Contributions, distributions directly between the IRLC and LLC owner. So what'll happen is the property starts, generating cash flow, money comes in, maybe you've got a new roof that hits you, something that used to cost 10 grand, 15 grand, now costs you 50 grand, and you don't have the money in there to do it. So now you've got a situation where maybe you have to make an additional contribution into the IRLC to take care of that expense. Well, that contribution has to go through the trust company. The trust company makes another investment in the LLC. On the other hand, you want to take a distribution. You cannot take a distribution straight from the IRLC to you. It's got to go from the LLC through the trust company to you. So that's a common problem. Working on an IRA-owned asset's a problem. Using the IRA-owned asset in any way, you or any other disqualified party, you can't go buy your kid a property using your retirement account for the kid to live in while he or she's going to school. Okay, that's a no-no. That's a prohibited transaction. Buying from, selling to a disqualified party, prohibited transaction. Use of taxpayers' personal insurance policy. A lot of times people go out and buy a property with a retirement account, and I have to say, look, you are not the owner of that property. It's the retirement account that owns that asset. It cannot be an additional asset on your homeowner's policy because it's not yours. And to have it on your homeowner's policy is a prohibited transaction. So that insurance policy needs to be in the plan's name and EIN or in the IRLC's name and EIN, period. It's a new thing. Think of your retirement account as Susie. You're not going to, Susie down the street, you're not going to take her money. You're not going to pay for her stuff. You're not going to, do things without talking to her. It's not you. You start thinking of the retirement account as you have the opportunity to commit one of these prohibited transactions. Think of it as somebody else. And we take it to the extent when you're coming up with a name for the IRLC. Just yesterday, I had somebody that called up and was talking to somebody in my office. Oh yeah, we already put the LLC together, and it was the person's name. Yeah, I do not want to see that. We really discourage that at every level. We want you to come up with a name for the LLC that is blatantly obvious to you. Anytime you look at that, hey, this is not me. This is my retirement account. If you put your name on it, that really, one, opens you up to some scrutiny with the IRS, and two, I think it just adds an extreme amount of potential confusion because you're going to look at that thing as you and not your retirement account. So when you engage us, that's one of the things we're going to talk about. Hey, what name for the LLC do you want, and what state of registration are you going to be interested in using? And we're going to look at, different states have different requirements. For example, Texas, you want a domestic entity. Otherwise, there's other tax issues there. Maybe if you're in California, you're not going to want to pay almost $1,000 a year for an LLC. I mean, that's absurd. If you're looking at Oregon, maybe it's 100, Washington 60, Colorado, I believe, is 40. I mean, Delaware is obviously a hotbed for those things. So we're going to look at where you live, where you're investing, and sort of take a look and figure out what state's best for the registration of your LLC. Once again, these are all reasons why you don't want to get ahead of yourself and start putting this thing together when we're probably going to have to scrap it anyway and redo it. Just think about this stuff, plan it out in advance. How do I do this? So we're talking IRAs. It's really simple. If you want a basic account, you don't even need us. I mean, we do basic accounts for people all the time, but you don't need us for that. You can go to any number of online self-directed IRA trust companies, and they've got online applications. You can go fill it out. I guess a word of caution, if you're going to do this without us, we've been doing this a long time, so we have relationships with different trust companies. We're very selective with who we're working with because we have two major concerns with them. Well, actually three. One, their financial stability is number one, but number two, we want to know how they're going to charge our clients. And I'm fundamentally opposed to any trust company that's going to charge my clients based upon the value of their investments. We want them to charge based upon the number of investments. And the reason I say that is, in the Wall Street world, back to my comment on valuations, okay? Wall Street, you know what any given stock's worth instantaneously. In the self-directed world, you've got a situation where it's subjective, and you don't want to be fighting with the trust company over the value of assets in your retirement account because they want to charge you more. So they want the thing to be worth more. And you're saying, well, gee, David, if I'm paying them based upon the number of investments, I've got 20 investments, I don't, that's going to add up. I don't want to do that. Well, I say this in the context of a checkbook IRA, because with a checkbook IRA or IRA LLC, the trust company sees one investment. The LLC owns those 20 investments. So you're not paying for 20 for the trust company, you're paying for one. And that's just something you got to be very careful. So when you're looking at that trust company, one, how do they charge you? And I would stay away from a company that's charging you based upon the value of the account, because I've had too many clients through the years fighting over valuations. And two, we need to know what's going on with respect to that company's specific requirements for the LLC. Now, some won't allow you to be the manager of the LLC. Some want a third party to review the LLC's activities annually. But these are things that, talk to us, ask the questions, and these are things that are of concern. If you're going to have a basic account, another consideration is you need to know the immediacy of investment that company is going to provide you, because they might say, I've got a 24-hour funding policy, which might be the case, but they might take a week, 2 weeks, a month to review what you're trying to make the investment in. So when you're to establish the account, you can do that online. And one of the forms you're going to fill out online is a transfer authorization form, which allows the new trust company to go to the old trust company, give me the money. We're talking IRA. If it's 401k to IRA, you're going to have to engage your administrator trustee and start to roll over from that 401k plan into that account. But once again, this is one of those things where most of the established self-directed trust companies are going to have online applications and process to get things taken care of. Once again, we work with a number of them, and people, even though people can do it on their own, people often pay us to establish accounts for them, but you don't need us to. But it's very simple. All right. If we're talking about an IRA LLC or a checkbook IRA, or in our company's term, the checkbook advantage IRA, you're looking at a situation where we're going to take whatever accounts are necessary or whatever you'd like to use. We're going to create the necessary custodial accounts for those IRAs. And then instead of having the trust company make the investment, the trust company is going to be involved with one investment, the investment of the limited liability company, that checkbook IRA account. So as the money's migrating from trust company A to trust company B, or 401k plan to the trust company, we will have also been establishing the IRA specific limited liability company, the EIN, gotten all that. So we're going to get the operating agreement, the articles of organization, and the EIN for that. You're going to go to a bank, open a checking account in the LLC's name and EIN. You are the manager, the members of the trust company. So you have the power of the pen with the bank. As soon as you've got the account established, you get us the account information. We direct the trust company to make the investment in the LLC, which funds that account. Now you're free to go make whatever investment you want to make, simply by negotiating the purchase between the seller and that limited liability company with you as a manager. It's a beautiful thing. Now, it is possible. So when we're talking about prohibited transactions earlier, prohibited transaction between disqualified parties, it's a prohibited transaction to transact between or for the benefit of disqualified party. It's not a prohibited transaction to transact along with. So you can go out and buy things along with it and you're just fine. All right, but you can't sell to, buy from, so on and so forth. So we have a number of IRA LLCs where we have spouses in there, or we might combine a traditional and Roth IRA in there, and all those things are fine. If we're going to have a IRA LLC with disqualified parties as members, we want to overfund that entity's purchase because we want to have enough money to make the investment, cover any shortfall until the cash flow off those assets is built to a point that we have some reserves there. Solo 401ks for people self-employed, without employees. I love the 401k plan, but we're just going to create a 401k plan and give you the EIN for it, the federal tax ID. You're going to go to a bank, open an account in the plan's name and EIN, and you're going to direct the funding of that 401k plan. From that point forward, making investments, they all work just like that IRA LLC. Everything's in and out of that plan's account. You've got the short of defined benefit plan. You've got the highest ability for annual contributions. No U-bit on leverage. So once again, when we're talking about tax on leverage with an IRA, you don't have it with the 401k plan. You don't have custodians. You can buy anything other than collectibles, and you've also got the ability to borrow from that plan, half what's in it to a max of $50,000. You do not have that opportunity with an IRA. So for people that qualify for solo 401k, I'm gonna encourage you to do that anytime I have the opportunity. A rollover business startup. So you've got the idea, you want to go out and create this business and you want to use your retirement account to do that. As long as we're talking 401k plan, we're fine. If we're talking traditional IRA money, we're fine. We cannot use Roth money nor beneficiary IRA money to fund the new 401k plan. But with a rollover business startup, we're just creating a 401k plan. We're creating a new C Corp, and the plan is going to buy the shares of the Corp. We also want our investor to have a 5% interest, personal interest in that C Corporation. So the business is literally owned by the 401k plan and you personally. It can have other investors too, that's fine. And now you're working for a corporation that is owned by your retirement account. So at some point, people often will want to get the account out of there, and you can't buy from the corporation, but you can take distributions of shares of the corporation until you own the whole thing. So this is a beautiful tool for people that are interested in their olive branch to the future, creating a new business. Got a few. This talks about combining personal. We've got a few examples we're going to get to. I know we're real short on time. I'm going to try to wrap it up in the next few minutes. I've got 5 examples and we're done after this. But if we want to combine personal money and plan money into a common investment, you've got 2 options there. You could do a tenancy in common. Each of these has its ups and downs. Tenancy in common is great because upon a future sale, well, number one, if you're combining 1031 money and plan money to go buy a property, it requires tenancy in common because of 1031's prohibition about a partnership interest. So partnership interests do not qualify for 1031. So if we want to combine 1031 funds and qualified money, it requires tenancy in common. But when the asset goes full cycle, at that time, you've got the ability to peel off. The qualified money goes back in the account, and then the personal money you can go and do a 1031 on. We can also do it via joint membership in a limited liability company. And this has the benefit over time of slight, maybe you've got this piece of property or whatever the investment might be. It can be commonly owned by the LLC that has you personally and the plan money in it. Now, ultimately, what people do, if they get the RMD age or they just want to take things out, you just start slowly assigning membership interests as distributions until you own the entire LLC, which then means you own all the assets of the LLC. So without ever, if it's a piece of property, you never have to even change the deed to the property, which is very attractive for people. So these are the 2 ways to do it. And it's really, it's personal preference, what's going to be right for you in a given situation. This situation that came up a number of years ago. This is a guy that worked for Intel, and he had a point where he had access to the funds. He had done well enough at Intel where he was going to take early retirement. He always dreamed of having a gold, silver, palladium mine. So he came to us and said, "Hey, I want to do this." And so we, went through his options and said, "Well, okay, if you're just going to make the investment in this stuff, you're not going to work. We can use a checkbook IRA, and that going to take care of you." He said, no, I want to, my dream is to actually have this thing and to work there and take a salary, hopefully, or, benefit from all this, the yield off whatever we're able to mine. And so we created the Rollover business startup for him, and it got him exactly what he wanted. He took the funds. We created the new C Corp, the C Corp, and he went and bought the mines over in Eastern Oregon. And it'd be fun to hear how he's done with that thing through the years. It's been quite a while since this was done for him. This is just a broker that she was a managing broker, so we could not use a solo 401k plan for her. But she had an invest. She came in and said, "Hey, I want to invest in what I know. I've got a client that's a builder developer that ran out of money on this project. The kitchen's not done, the bathrooms aren't done. He's in a bad spot. I need to put some money in. We need some money in there to finish this project. So I want to save him, and I think it's going to be a great investment." So we put the checkbook IRA together. She ends up buying the property from the guy, ends up finishing the project. And she had, this guy's a friend. So basically she had agreed, "Hey, I'll buy this from you." He said, "That's fine. I'll give you 1/3 of the net profit in addition to what I pay you for it." So she ended up making $150,000 on this transaction and gave the guy an extra $50,000, which made him happy, got everybody. So it took a problem property, a problem situation. She had the skills and the resources to take care of. She saw the opportunity, and she was able to invest in what she knew with that checkbook IRA, and that transaction happened quickly and was lucrative pretty fast. This transaction, it's one of those things where, once again, invest in what you know. And this is a commercial lender that came to us and said, "Hey, I've got IRA money, I've got SEP IRA, and I'm interested in, I've got a trust. I do have a self-directed IRA right now. I'm just not very happy with it. I've got a basic SEP IRA with a trust company that it's not a checkbook IRA, and they're charging me based upon the value of my accounts. I'm not happy with them." So, I asked which trust company it was, and, he told me. I thought, "Oh yeah, not surprised." Anyway, so we talked about a checkbook IRA. I said, "Well, hey, tell me about your job. I know, 30 years ago when I knew you, 25 years ago, I knew you had a big mortgage company, lots of employees. What are you doing now?" And he said, "Well, I'm, a real estate broker. I still make loans too." I said, "Well, do you have employees?" And he says, "No." He says, "Just me." I said, "Well, okay, so you've got a SEP IRA because you were sold a SEP IRA, but forget that. Let's use a solo 401k plan." So we're putting a solo 401k plan for him, putting it together for him, which is going to give him all the flexibility that the checkbook IRA has and more. He's got the ability to borrow from the plan, so on and so forth, and he's just going to make loans with that 401k plan. This transaction, this is something that's happened a lot in the last few years. You think of gold, and you think of gold, and if you watch our channel, this is an example of a gold bar from the 60s of Fort Knox. It's not real, so don't break into my office. But this thing is 14.3 ounces. So you do the math, and in the 60s it was worth. Was it worth $531? It says at this point, but I think when I did the math last, this was roughly $60,000 piece of gold if it were real. So we have lots of people that have done very well. The last month or so, it's been sort of bumpy ride for gold and silver, but precious. We have lots of people who want to go buy precious metals. And you can do that with a basic account. You're going to have those metals. You're not going to have physical custody of that stuff. We have lots of people that are really concerned about the world, the economy today, and they want physical custody of the stuff. Well, years ago, we had a situation where you maybe could have bought a safe and put the safe in the house, and not you, your retirement account would buy the safe, and the safe's now in your house, and you buy the gold and put the gold in the safe of your house. Now there's some case law out there that says that's a no-no these days. So what I just told you, I shouldn't even told you. Forget it. I didn't say that. But what we typically have, you've got a choice. You can make an investment from a dealer that is going to have the physical custody of the stuff, or more often than not, people want a checkbook IRA because they want to have that gold where they want it, gold, silver, whatever it might be. So what happens today is typically we're going to do the IRA LLC. The IRA LLC is going to go engage a bank, buy a safety deposit box in the IRA LLC's name and EIN. And when you buy the precious metals, you'll take delivery, put those metals in that safety deposit box. So it's literally where you put it. So that's sort of the MO there. By the way, we've all heard ads for gold IRAs. There's no such thing. Okay, a gold IRA just means it's a basic account set up by either the dealer or the trust company to have that stuff. It's just a self-directed account that is specifically set up only for gold. My position is, hey, why not have a retirement account that allows you to buy the gold and anything else the law allows? I mean, there's no such thing as a gold IRA, just FYI. Last example, retired people, if you've been to my classes before, you've heard me give this example. I just love it. It sort of really summarizes the extreme possibility of what is there with a self-directed account. So retired couple comes to us. They want to take his and her IRAs to go out and buy a mobile home RV park. And so, okay, well, we'll just do a checkbook IRA, single LLC with both retirement accounts as its members. Then they talked about living there and managing, being compensated for management, neither of which is okay with an IRA, okay, period. So we shifted gears from that checkbook IRA to a rollover business startup. We took his and her IRAs, migrated those into the new 401k plan. The 401k plan bought the C Corporation, which bought the mobile home park, which then employed them as the on-site managers. So they got an investment for their 401k plan. They got a job and a place to live, all with this one action, which I think is really an amazing situation there. So plan ahead takes 2 to 4 weeks to establish your self-directed retirement account. You can purchase virtually any investment with an IRA, SEP IRA, or Roth IRA, or 401k plan. You can purchase with family members and friends, cannot purchase from or for them. Your IRA or 401k plan cannot sell to you or any other disqualified party. You can use an IRA or 401k plan to buy a property with a mortgage, negotiate from the deal's inception in the IRA or IRA LLC's name or the 401k plan. Do not overextend. Plan on keeping a nice cushion of reserves. Once again, my name is David Moore. I really appreciate your attendance today. If you've got questions, please don't hesitate to reach out. If you'd like to see this slide deck, let us know. You can, we can send you a copy of it. And once again, this presentation will be up and available on YouTube for future viewing. If you're interested in 1031s, please don't hesitate to reach out to us at Equity Advantage, 1031exchange.com. You can take a look at IRA Advantage at iraadvantage.com or .net. And if you're interested in, if you're a real estate broker and you're trying to get product in front of people, we also have a property listing site, which is post1031.com. There is a glossary after this page that will be in your slide deck talking about different terms in the IRA 401k world. And it's about a half dozen pages, so I think you'll find that helpful as well. Thank you so much for joining us today, and I hope you found it helpful, and I look forward to talking to you soon. David Moore, IRA Advantage, signing out. Thank you. Bye-bye.